Well, Warren Buffett's performance may be the envy of investors around the world, but here in the Asia-Pac, Australia's hedge fund industry is banking on its own success. Chris Gosselin is CEO of Australian Fund Monitors. The company tracks hedge fund performance across Australia, and he comes to us live from Sydney today. Chris, thanks so much for joining us on the program this morning. Looking forward to chatting with you. Let's kick it off and talk about the June results in your latest report. And it shows that hedge funds are up about 1% so far in June.
Yeah, 1% for June when all the numbers are counted, which was below the ASX 200. So what we've seen is that hedge funds have provided very good protection in Australia on the downside. Last year when the markets were down sharply, 25% of the funds we'd tracked were actually positive. As we've seen the ASX take off and equity markets rally strongly from their oversold position at the beginning of March, hedge funds have ridden that to a degree, but not as hard as the actual market has.
Let's talk about a year ago performance. Those funds down 8%. Is that just to be expected given the market conditions we've seen over the past year?
Oh, I think so. I think, an 8% fall over 12 months, whilst not good for a hedge fund, or bear in mind this is all the funds, the good, the bad and the indifferent put together, minus 8% is not bad against the ASX, which was down over 20% over the same 12 months. So there has been significant protection on the downside, although not all funds have been able to produce a positive return.
Let's talk about equity-related funds, because your research shows the best gains were in those funds. Is that correct?
Yes, certainly. With the equity market rally, the funds that struggled last year have done very well, and certainly better than the non-equity-based funds. So the global macro, the commodity-type strategies, which did well last year, haven't been doing so well in 2009. And if we look at it even closer on that, we look at the best performing funds in the first half of 2009. Many of them were in fact very poor performers over the 12-month period. There are only 2 funds who are in the top 10 for the first half of 2009 that were positive over the past 12 months. So all the others really struggled, some of them even down sort of 30–40%.
We're going to get to that in a moment, but let's talk a little bit more about strategy. And I want to talk about those equity 130/30 funds posting the best average returns in June. Can you explain to our viewers a little bit about how these funds work?
Well, a 130/30 fund is really a style of long-short fund, except it has some limitations on how much it can go short. Effectively, their maximum short position is 30%. They go short 30% of their portfolio, and they can reinvest that 30% so they can be 130% long and 30% short. There are variances on this. There are 120/20 funds and 140/40 funds. They all vary slightly, but the concept's the same. And the way they differ from a normal long-short fund or a market-neutral fund is that they do have that restriction on how much they can go short. It allows them to get some protection in the bad times, but not a huge amount, not complete protection, say, as a market-neutral fund would get. On the upside, when the market's running strongly, then they tend not to have so much short cover, and they can perform well in strongly performing markets.
Let's delve in a little bit more to some of the top-performing equity funds. I want to find out why they did so well, and I believe we have a chart here of those funds that performed so well over the quarter. It looks like the OC Concentrated Equity Fund and the Now Small Companies Fund at the top of those lists. Why did those 2 particular funds come in so strongly through June?
Well, as the name would suggest, very concentrated portfolios. But if you look at those returns over a 12-month basis, you'll find that those funds didn't perform so well. So when you've got a very concentrated portfolio, if you don't manage the short side very well, then you've really got some problems. In this rapidly rising market that we've had and we've yet to see what the fund industry is going to do in July, but the ASX 200 accumulation index was up 7% in July, then you're going to get those concentrated funds with heavy bets on specific stocks, especially ones that have perhaps been unloved over the course of 2008, doing particularly well.
Let's go back to a point you made a few moments ago, and that's the 12-month performance. Even though these funds, the ones we just showed you on that full-screen graphic, did well in June, the 12-month performance rather isn't so hot. And we refer back to that Now Small Companies fund, down 41% over the past 12 months. The OC fund, which you were just talking about, down just about 5%. Is this another case of the market just something we might expect for 12-month performance with these funds, even though they did so well in June?
Well, yeah, it really depends. You got something like the NIOS fund. Small companies were particularly hard hit on liquidity. I actually just, I think there's one number there that's wrong. The Macquarie Special Events Fund was actually up 18%, I think over 12 months, not down 18%. I may be wrong on that, but you might just want to check that one. But the NIOS fund particularly, it's very concentrated, very focused on the smaller end of the market. The small end of the market suffers from liquidity issues when the market's going down. They're able to bounce back very strongly when the market gets back into favour. But you're going to have that sort of severe problem in a rapidly falling market. Now, hopefully, the end of the falling market or the end of the panic of 2008 is over. But you do need to watch that some of these funds are very specific in their strategy, and therefore they'll do well in certain market environments and considerably less well in other environments.
Obviously, management of these funds playing a key role here, and your latest report highlighting that, talking about the importance of management, consistent management, and long-term gains. Chris, just how critical is that to maintain that long-term performance in these funds?
Well, it's very important. You know, there's no point being down 50% one year and back up 50% the next year. You're back up to square, and you've had a very rough ride in the meantime. Consistent performance, we've found, comes from the good managers. So if we look at the top 10 managers over the past 12 months, these are managers with at least a 3-year track record, equity-based and Australian-focused equities, then 80% of them were also in the top 10 over their longer period, so since inception, whether that was 3 years or 5 years or in one case 11 years. So it just shows that consistency of good managers is very important, and it does help. Now, every disclaimer in the world, certainly in Australia, always says that past performance is no guarantee of future performance. But the reality is that managers who perform well over a longer period of time tend to perform better going forward as well. And it's not a guarantee, of course, but 80% of managers, as I said, who were in the top 10 over the past 12 months were also in the top 10 over the longer period since inception.
Chris, we're going to hold it there. We're going to come back after the break, continue our discussion about Australia hedge funds. We're chatting with Chris Gosselin from Australia Fund Monitors. And we've seen a resurgence of late in the hedge fund business in the Asia Pac, and we're continuing our conversation now with Australia Hedge Fund Monitors Chris Gosselin, joining us live today from Sydney. Chris, let's look across the region. Curious if you anticipate another wave of fund startups in the Asia Pac and then in Australia.
Well, we've seen a couple of startups over the last few months, but it's very tough. The real problem is capital raising, and no one's really prepared to be very or take much risk on that. Institutions, pension funds are becoming much more conservative, obviously, on the way they invest in hedge funds. Compliance, due diligence, very important. Track records, most of the institutions, professional investors are looking for a minimum 3-year track record. So that first 2 or 3 years is a tough time for the smaller startups. There are some, obviously. The other thing that's not happening is, I think during the early part of the decade, we saw a lot of funds start up as a spin-off to an investment bank's prop desk. So you had teams leaving prop desks and being set up, being funded by investment banks. That's much more difficult to do now.
Chris, let's talk about IPOs. Any talk of hedge fund IPOs given the rally we've seen in the markets and the resurgence of funds across the Asia Pac?
No, we don't have many listed funds in Australia. I mean, there are some. Platinum's probably the best known, but I can't see many coming along in the next 12 months. I certainly don't know of any. We have a structure in Australia called an LIC, a listed investment company, and some funds have listed over the past 6 or 7 years that way, but that's been a problem as well because they've all been trading at a significant discount, or most of them have been trading a significant discount to their NAVs. So you can buy these things and you do get some liquidity by being able to trade them on the ASX, but they're at a significant discount. Now, maybe there's an opportunity to buy them at that discount, but there's still concern from the investor's point of view on the model and the fee structure. You talked earlier about some of the performance of offshore listed funds. One of the issues there I think that people are concerned about is the high watermark structure on performance fees. Most funds only get paid performance fees, which can be 20% of outperformance. They only get that after they've risen back up to the previous, what they call high watermark. So they've got to reach, if they've lost 50%, they've got to double before they start making performance fees again. And I think that's dragging on their earnings.
Hey, Chris, we just have about 30 seconds. A quick question for you. We've seen a wave of redemptions over the past year. Do you see that continuing for hedge funds there, or has the worst passed?
Definitely the worst has passed. The December quarter was worse for that. It was still continuing a bit in March. We're starting to see allocations back into the sector, both from offshore and locally. So some positive news on that. It's not easy. There's not the extent of money coming in, but at least it's now positive rather than negative.
Chris, we'll have to leave our conversation there. Thank you so much for coming on the program this morning. Chris Gosselin, CEO of Australian Fund Monitors.